Hello, my name is David Buckland and welcome to this week's Video Insight. I recently hosted our first webinar with the team from our global partners Polen Capital, Paul Williams, Head of Global Distribution out of London, and Damon Ficklin and Jeff Muller, the funds portfolio managers out of Boca Raton in Florida. The Polen Capital Global Growth strategy was launched in late 2014 and follows the exact methodology and philosophy of the company's 3-decade-old masthead product. This means an absolute focus on quality businesses, including a sustainable return on equity exceeding 20%, exceptionally strong balance sheets, stable or growing profit margins, abundant free cash flow, and real organic revenue growth. These guardrails mean many sectors, including energy, financials, industrials, materials, real estate, and utilities, are generally excluded from the process. The benefits are the Polen Capital Growth strategy has exhibited better returns with less risk than the market. In the 6 years and 1 quarter to the 31st of March 2021, the Global Growth strategy has delivered annual average returns in Australian dollars exceeding 16% after expenses, approximately 5% better on a per annum basis than the MSCI all-country index in Australian dollars. Polen Capital invests across the growth spectrum, and this slide demonstrates the current 27 stock portfolio with safety on the left and growth on the right. The objective is for the portfolio in total to deliver average annual earnings per share growth over the longer term of at least 15%. That means, for example, the slower growing but more reliable Nestlé is counterbalanced by the much faster growing Adobe. If the overall portfolio can achieve 15% per annum earnings per share growth, the return on the fund should follow. Portfolio turnover is very low, historically less than 20% per annum, as Polen Capital's focus is on a concentrated portfolio of great businesses, but only after very patient analysis. Over calendar 2020, a period when the full economic cycle seemed to be compressed into 1 year, only 4 stocks were sold: Novo Nordisk, O'Reilly Automotive, EssilorLuxottica and Oracle. And only 4 stocks were added: LVMH Moët Hennessy, Autodesk, PayPal Holdings and Estee Lauder. On this blog, I have recently written about LVMH Moët Hennessy, a world-leading brand business with $70 billion of annual revenue. It is expected to enjoy a 15-fold rise of the global affluent in China over the balance of this decade. That's all I have time for this week. Please continue to follow us on Facebook and Twitter, and thank you.